for nearly 20% of additional price upside by the end of 26.
177% this year. Have you ever had a year like that?
No.
Okay.
No, absolutely not.
Did this surprise even you on some level?
It did. I mean, it's telling us something. It's a bursting bubble, and my spidey senses really got triggered last year.
Have you ever noticed how the things people call old often end up outlasting the new stuff? Hi all, I'm Raj, and today I want to walk you through something that might sound crazy at first. The idea that gold could outperform Bitcoin by 2051. Not because Bitcoin fails, but because gold is something people go to when everything else feels unstable. Let's start with the last year. In 2025, gold absolutely dominated performance charts. It ended the year up over 60%, making it one of the strongest performing major assets on the planet, ahead of most stocks and financial assets. And remember, these aren't small numbers. Gold breached all-time price records, climbing above $4,500 per ounce in early 2026. Bitcoin had a good narrative in the last cycle, reaching price levels well above $100,000. But during that same 2025 period, Bitcoin's gains were not as strong relative to gold. In fact, in some metrics, Bitcoin lagged significantly compared to gold's jump. That tells us something important. When markets start looking for safety over speculation, gold tends to rotate to the top. Now, let's compare the two assets in terms of real behavior, not hype. Bitcoin has had explosive growth in past cycles, and in 2025 it still saw moments of strength. Projections had it potentially testing six-figure valuations again. But against gold's rally, Bitcoin's relative performance softened. Analysts pointed out that the Bitcoin to gold ratio, which measures how much gold it takes to buy one Bitcoin, fell nearly 50% in 2025 because gold was outperforming. In plain terms, even if Bitcoin wasn't terrible, gold simply outpaced it. And that's a rare situation historically. So why did gold perform so well? A big part of it was fear, not just greed. In late 2025 and into 2026, markets reacted strongly to geopolitical uncertainty, especially after major events in Latin America involving Venezuela. After US forces captured President Maduro, markets interpreted that escalation as a sign of growing political risk, and gold rallied as a result. It wasn't just one event. Global tensions, trade conflicts, and uncertainty about monetary policy all drove investors towards the safest assets they could find, and gold is traditionally the anchor in times like that. This moves us into something deeper, how humans actually behave with money. When uncertainty rises, wars, political instability, central bank pressure, or even the fear of one, people stop chasing high growth and start protecting what they have. Economists call this the precautionary motive. Basically, when people fear future loss, they hold assets that preserve value, not assets that promise growth. Gold is a perfect example. Bitcoin, exciting, digital, sexy, doesn't always fit that precautionary bill. It requires belief in technology, infrastructure, and regulatory tolerance, items that suddenly feel fragile during geopolitical stress. Gold doesn't require trust in the system. It's physical, history tested, and universally recognized as money that lasts. Now let's talk about geopolitical implications, especially bold moves like US engagement in Venezuela under Trump's leadership. While headlines call it occupation or military action, markets interpret it as a sign of rising geopolitical risk. And when risk rises, safe haven demand rises too. In early 2026, gold hit records partly because investors were pricing in uncertainty around military tensions, political pressure on financial institutions, and the possibility of broader conflict. That risk premium gold trades at isn't theoretical. It's built into prices. Every time investors get nervous, gold tends to outperform risk assets. Let's be clear, gold isn't just rising because people are scared right now. There's a structural backdrop behind this. Central banks have been buying gold at historic rates to diversify reserves. That's not speculative, that's institutional allocation. Even mainstream forecasts from big banks like Goldman Sachs and Bank of America see gold averaging significantly higher levels through 2026, some above $5,000 per ounce. These aren't fringe predictions. They come from major institutions factoring in currency weakness, geopolitical risk, and macro instability. Now the important question is, does Bitcoin continue to rise? Sure, it might, and it could even see new cycles of strong performance if risk appetite returns or technology adoption increases. But here's the key. Bitcoin's biggest strength, volatility and speculative growth, is also its weakness in times of fear. During extended periods of uncertainty, assets that are stable and historically reliable attract more capital than assets that can swing 30% in a week. Gold doesn't need an internet connection. It doesn't depend on code. It doesn't base its value on belief in a new financial paradigm. It simply exists, and people value that when trust in everything else feels fragile. So here's the real takeaway. Gold may not be as exciting as Bitcoin, but over the long term, especially in a world that might grow more uncertain rather than less, gold's role as a store of value could see it outpace Bitcoin by 2051. Not because Bitcoin fails, but because gold wins when fear matters more than hype. Let me know what you think, gold, Bitcoin, or both. If you liked this video, please subscribe and leave a comment. See you in the next one.